We start off with the late-day rally in the markets. The S&P and Nasdaq both jumping nearly 8%. The Dow up more than 260 points. All three indices erasing losses from earlier in the session. The strength coming despite a big warning from Target this morning. The retailer saying rising inventories will hit profitability this quarter. And that got us thinking about a couple big questions hanging over these markets. First, are Target's inventory struggles emblematic of broader issues in the retail space? Second, when supply chain challenges finally get resolved, will demand for these products still be there? And finally, what will the consumer look like by then? They'll be facing higher interest rates and potentially a much softer job market. So some big questions to chew on. Guy, where do you stand on this?
Yeah, the second question is where I want to attack. And Tim mentioned this last week. Microsoft warned on FX, but Tim said, if they start warning on demand, that's going to be a problem. And I think that's true with the retailers as well. Listen, it seems to be somewhat Target specific, Walmart specific, although I don't think the rest of the retailers are going to be insulated from it. But I'll say this, if demand is the next thing to fall, you have to believe there's going to be another leg lower in the broader market, Melms. But
today, the markets finished higher. And Target didn't do so bad either. Target was down 2% on the session.
Target did fine. Look, markets traded fantastic today. You mentioned in the opening up 1% into the close. We were actually up 1.96% from 934 to the close. In other words, we opened down. Everybody thought this was another Target Walmart day. Incidentally, Walmart had an investor day yesterday, and we were just talking about this pre-show. I kind of feel like Walmart, without the formality of a cut on certainly on the EPS and on margin, they basically said the same thing. They said, we've got $3 billion in inventory we need to do something with. We got to get out there early. Anything that's seasonal, we're going to cut it dramatically. And as we get into second and third, really third and fourth quarters, we're going to start to actually push some of that back even more as we can. I think Walmart, we've heard this from all of these folks, and I think there's a bit of a reassessment here. But for both Walmart and Target, I still believe that their consumer, especially their consumer, we've talked about this, is more under pressure. There's certain parts of the merchandise shift that we know clearly is happening. But the investments both of these companies have made into logistics and into ERP and into digital and e-commerce are things that are long-term reasons why you want to own these stocks. So in the short run, I get we're all talking about the consumer every single day and where demand is going. But at 14 times next year and at 20-ish times, even a little cheaper now on Walmart, I think these are stocks you can own today. We know the consumer is going to fall under some pressure at some point. But these companies aren't as bad as they appeared on those Q1 numbers.
So there was a lot to think about here. For one thing, why? Why now? Why 70, 18 days later? What happened so dramatically that Target felt like they needed to come out and sort of give us updated, I don't know if it was guidance, but updated, oh my God, we have way too much inventory. I'm not exactly certain when they got that, when they realized they had so much inventory. And I'm not exactly certain about how is it that Amazon, whenever they announced, right, we started to see pressure then. Interestingly, Amazon said also, we're going to get rid of space. We're going to get rid of distribution space, rid of warehouses. That's interesting. Clearly, they were in a different place than Target, who said, now we need more space because we have so much stuff and we got to put it somewhere. And if you think about what was selling and what wasn't, they told us, things for the home, things that are sort of larger, furniture, patio furniture, Walmart cited, TVs. That takes a lot of space. So that's why they needed the space. But clearly, for all of it, feels like margin pressure will remain for a long time until they work through not just the inventory that they built during this past quarter, but the inventory that they're continuing to build in the hopes of in the hopes of selling it, of course, so hope for a strong back to school and a hope for a strong holiday. It does make me think that anything related, like a Bed Bath & Beyond, anything like that, you would think would also see pressure. I'm really quite shocked that Target did not trade down more. I sold when they announced 3 weeks ago. I waited the 3 days. I bought some more stock. I sold that stock today, kind of just the same price that I bought it, because had I known this then, I probably would not have bought more then. So is it priced fairly here? I think so. I own a bunch. I don't have high expectations, but you and I were talking about today, and you questioned, why don't they just get rid of guidance?
Why don't they pull it? Because to change your guidance just 3 weeks after you initially pulled down guidance, it's akin to pulling it because nobody will believe it anymore. Who's going to believe this guidance if just 3 weeks ago they were giving guidance and now they're going to change it, right?
You don't get credit if you make it, and you get hurt again if you miss. Why have it at all? Just sort of play it out. I always think businesses shouldn't give guidance, but now they gave it. They're kind of stuck. They should have taken Missy's advice and pulled the guidance.
They
at least for now.
But next time.
Next time, now I know.
Dan.
Yeah, I think if your antennas are not up based on whether they give it or not, I mean, they did this, okay? Snap did it last month. You know, the changes that are happening very quickly, and I think it's really interesting that we just got through a bunch of, software earnings over the last couple months, and these were kind of like second-tier names, and a lot of people felt really good that they were talking about, well, demand's still there. If you look at what's going on with the consumer right now, we have consumer credit ticking up. It's getting to all-time highs. We see consumer savings going down. We know what the Fed's doing. We know what commodity prices are doing. We know what inflation prices are doing. So it's like, listen to them. They're telling you this. Actually, they should be giving you this guidance. And the fact that they're doing it so quickly after they had just guided officially, I think is really important here. So, as an investor who's been in the markets for 25 years, these are not the things that you want to start explaining away when you think that we might be at an inflection point. And again, we're trying to unwind this experiment of $4 trillion of fiscal and monetary stimulus to battle a black swan event. We're raising interest rates. We've only done 150 basis point. 2 more are expected over the next month and a half or so. QT just started. There is no reason to try to get in front of this. I believe this is the tip of the iceberg as it relates to the consumer. These massive companies would not be guiding this frequently, and you know what I mean, if they didn't believe that something was happening that will not be corrected in 1 quarter.
I'm with you on that.
Thank
but
you.
The fact of the matter is the markets don't seem to care. So we just put up the Snap, the Microsoft, the Target, all within 30 days or so. They cut their guidance, right? Today, nothing, hardly a reaction. So why not?
Because they priced Target down 25% on a 15% earnings revision. I mean, to me, Target is so much of a better store post-COVID than it was going into it. The investments that they made and the market share gains that they took coming out of COVID, I don't really care. And I'm not investing day to day. I mean, I am on some stocks, and there's tactical trades and their investments. But I look at Walmart and Target, and I think there are a lot of parts of the consumer that are going to be under a lot of pressure and significant pressure out 6 to 9 months. But when I look at those two companies, those aren't the places that I'm freaking out. And I think the market freaked out on them.
Let's play this out.
Well, I like these.
So,
is this a game or is this no?
Sounds like
you can call it what you want to call. If you want to play it like a game, that's up to you. That's entirely
She calls it a mental exercise. You call
For me,
it
it's a game.
That's fine. Okay, let's say Target and Walmart and all the others out there, they cut their inventories by slashing prices, right? They've got huge deals going on. You buy TVs, you buy patio furniture, you got your decked out guy, you got a new grill, all that stuff.
I can only imagine what that looks like.
You pull forward spending. 6 months from now, what state is the consumer in? And what did they just spend on all that markdown inventory that just hit the market?
Well,
where are we then?
Well, the retailers effectively are doing the Fed's job for them in terms of fighting inflation, right? I mean, that's one aspect, so that's a good thing. We'll talk about energy in a second, which is completely separate. Where's the consumer? To Dan's point, not in great shape. I hear how great the consumer is, but quite frankly, credit card debt now approaching $1 trillion with a T. That's pretty interesting. And consumer savings is now levels we haven't seen, I want to say, in 13 or 14 years on the wrong side of the ledger. So never underestimate the consumers want to spend. I've said that for years, but you have to start questioning their ability to spend. To your point, 6 months from now, under those guidelines, I don't think we're in a good spot at all.
Right. So we talked about the overbuild. Amazon in particular, like you guys just mentioned, they did too many warehouses. They hired too many people. And Tim is right. These are investments that will pay off over a long period of time. I am surprised that Amazon is doing away with some of those warehouses. You would think a company that's doing $500 billion in annual sales on its way to probably $1 trillion in 10 years would probably need that infrastructure. But here's the other point. We haven't even mentioned this, okay? And I know that we talked about it a little bit. And last night, Tim and I went back and forth on this. Unemployment is basically back to those pre-pandemic levels at 3.6%. That was a 40-year low. Everyone felt great about that pre-pandemic. It went to 10%. Here we are now. And the headlines that I actually, again, that keep getting my attention are all of these companies that are laying off or slowing down hiring. And that means there's going to be slower wage growth.
And white-collar hiring, salaried workers.
Correct. And then the other point about that, I mean, listen, so this is all happening. David Rosenberg Research, he mentioned, I had a conversation with him a month ago. He said if you see a 0.3% of increase, okay, in the unemployment rate, you almost always see a recession follow that. So if we got to 3.9 or 4%, and I know a lot of bad stuff has to happen over the next 3 to 6 months for that to happen, but it's not that crazy to think about if we're burning off all of this excess. And there, all of a sudden, I don't know if you guys also saw Atlanta Fed, GDP now, we know that we had a negative print in Q1. Right now, it's below 1% for Q2. And technically, if it swung to negative, and this is going to be a bad last month of Q2, then you got a recession.
So I come back to the point Melissa was making, which is, okay, all that is so, and yet the market doesn't seem to care. They're sort of looking beyond it because they think, all right, well, maybe all this pressure, inflation will come down. We'll do part of the Fed's job for them. We already have a lot of hikes priced in. And so we're looking past that. If the market is a forward-looking indicator, which it is, so Dan, you must think the market is nowhere close to.
Well, we have hundreds and hundreds of stocks in the Russell 3000 that have been cut in half. I mean, they're already telling you we're in a bear market. Don't just look at every risk asset. We haven't talked about housing is about to turn. We know what just mortgage rates.
So I'm asking, is that price? That's not pricing in fabulous
but
news.
I think the S&P is a fugazi now. I mean, it really is if you think about it, because it's really what is it indicative of? If you're all right, hold on a second. So the last time the 10-year U.S. Treasury yield was above 3% was in the Q4, Q4 of 2018.
Uncharted territory on rates. I'm not arguing with any
of this. And the S&P back then literally dropped how much, Guy, in a 2-month period?
19.9% from Halloween until Christmas.
And you're telling me that we got down 20% given everything that's happened since then, and that's it for the S&P?
You just said half the stocks in the Russell 3000 are down more than 50%. If you look at the small caps, they were down at a 12.5 PE, which is a global financial crisis low. So if you look at what the market has done, this is my only point. I don't want to fight the corner of that. I think the economy is going to get stronger and job growth is going to get better, because that's not my position. My position is that the market has made a move and priced in a lot of stuff. And I think this is what Karen was saying in terms of, look, I look at Walmart trading at 123 and change. This is a company that was trading at 120 back in 2019. Not that, you have to look at EPS. You have to look at a lot of different things. The stock price isn't linear. But I'm just telling you, I think we've priced in a lot of bad news. And if we're not having a recession, the market is too cheap here.
Except that you guys make the point night after night that maybe big cap tech hasn't priced it in.
For sure.
And that's where the pain is to be felt in the market.
Dan?
See, look at her paying attention. I don't know if you guys caught this. Guy repeated something I said just a minute ago, like you repeated it right afterwards, and you're actually just pushing us forward 100%. I mean, that's it. Microsoft just eked out that little bit of news that's going to precede the guide down, okay? And Apple's likely to guide down, and Tesla's likely to guide down. And we know that Facebook's quarter is going to stink, and Twitter's quarter is going to stink, and the list goes on. And that's how that E is going to catch up to the P that's already come down.
All right.